Volatility is back. The markets are almost in correction territory, and there's a lot of talk about a possible recession. We're going to cover all that and more in today's episode of the Paper Gains Show. So welcome. I'm Johnathan Rankin. I'm one of your hosts, joined by my co-host, Matt Magee. Matt, how are you doing today?
Doing great. Looking forward to diving in.
Yeah, we've got to start off with what's going on in the markets. I mean, we're filming this March 10th. The market just closed and the NASDAQ's down almost 13% from its high, officially in correction territory. S&P is almost there. It's been a brutal day in the market. What are your thoughts on what's going on in the market right now? And is this something that's a blip, or do you think that we're going to see this continue over the next couple of weeks to months?
Yeah, to answer a couple of those questions, do I think it's here to stay for the next 6 to 12 months? Hopefully not. My crystal ball is as good as yours, but do I think it lasts the next couple weeks as we figure out tariffs until those go into effect with Canada and Mexico? Yes. Do I think we've hit a bottom? Probably not. It doesn't seem like there's really any certainty that that's really what I would say is missing. There's just a lot of uncertainty with tariffs, with Doge. I think the broader economy is still extremely strong. I think the NASDAQ, like you hit on, was at all-time highs, was arguably overpriced to a degree. And so I think this is very natural and healthy, but I do think the next couple of weeks could be volatile until we get some certainty around tariffs and eventually Doge and what that does to unemployment.
Now, don't you think? See, I think this was all overdue. I mean, we were trading at extreme multiples in the market, and this is something that it just needed. There was a lot of complacency that set in. I think the tariffs, if anything, they got rid of some of that complacency, and we're starting to see that come to fruition now, where people realize, why am I paying these multiples for some of these companies? But I think the bigger question is, you and I, we work with clients that are focused on legacy capital, retirement, and making sure that their money is there for them when they need it most. So, one of the questions that I know I've gotten a lot, and I know you're probably getting as well, is, okay, so what do we do right now? Market's down, like I said, S&P is almost in correction territory. Are you making changes right now? Is this something where are you holding firm? What if you're telling one client, now you're telling many, what should we be doing right now?
Yeah, telling them to hold steady and that we plan for this. This is ideally depending on how long they've been a client, but this is what the portfolio is built for. This is what your financial plan is built for. To your point that this was overdue, this is very natural to stay calm and don't panic. And that's broadly what telling clients, and then it's specific based on kind of if somebody's still working or if they're an 80-year-old that is living on one income, predominantly Social Security in the account. So that's a different conversation. But for the most part, trying to reassure clients that this is expected and totally normal. What about you?
It's funny because I went through 07, 08 with clients, went through, obviously end of 2018, 2020, 2022. So, a number of corrections now that I've seen. And it's funny because everybody always wants to make changes at the worst possible time. You talked to them a couple of weeks ago when the market's at all-time highs saying, hey, we should talk about risk management. We should, pare down some risk. And everybody likes making money. Everybody loves it when things are going up. And now that the market's starting to go down, it's, well, what should we be doing now? It's like, no. This is why, you have the conversations of the next conversation we're going to have is, at what point does this hit a metric where we want to start buying risk assets? I'm not saying we're there yet. Like you said, I don't think we necessarily seen the bottom. We'll have to timestamp this if we did, but I don't think we have yet. But at a certain point, that conversation changes as to, all right, now we have to be buyers as opposed to sellers, because we should have been sellers when everything was at all-time highs. And that's I think obviously for a lot of people it's you've got an asset allocation, and you're consistently rebalancing, and there's a systematic approach to it. But I know that there are some investors that like to be a little bit more tactical. And so, being able to, sell as the market's reaching all-time highs and starting to buy as things are selling off. I mean, that's, a little bit of that tactical nature that I think some people like. So I think that's the next conversation. But, one of the things that kind of dovetailing off of the volatility side of it is the fact that now we're actually seeing, possible signs of a recession that we might see. There was the Atlanta Fed came out, adjusted GDP down to, what was it, negative 2.5% or something along those lines. And I don't know if you saw there was an interview just this past weekend with Trump talking about, could this actually lead to a recession? And he didn't rule out that this could lead to a recession. So, do you? So I think the big question is, do you think one's coming? And my stance on this, but I want to hear yours.
I'm gonna go no. Like Scott Besant said, it's a detox. It's not a recession.
Yeah.
Like the rebranding there. But to that point, I think let's not forget, like a month ago, we were talking about how great the economy is and how strong everything is. Markets were at all-time highs. I would say sentiment has changed, and obviously that's reflected in what we just hit on. But the economy, I would argue, is still in a very strong place. I think we're headed into summertime. That's when America is built on consumerism. That should bode well in the summer, unless I'm terribly wrong and consumers just stop spending this summer, which in that case, we might need another Taylor Swift tour. She carried us, I think it was last summer. But no, I'm going to go no recession for 2025. Doesn't mean we don't have market volatility, but I would argue where the economy is still very strong.
See, and I me, I'm going the opposite way. Now, maybe this is because, when I started this business, I started in the business and then it was like immediately into the cliff of, the global financial crisis. So maybe I'm a little jaded and, maybe there's a little perma bear somewhere in there, but I think the economy has been on fragile footing for a while now, and obviously there was strength there, but a lot of it was underlying because of, fiscal spending that was being done. And now that Doge and Trump's cutting a lot of that stuff, you don't have that backstop. You got a Fed that stopped reducing rates. Now, at some point, they'll probably get back to doing that. But, is there going to be the Trump put, as they call it, or the Fed put, in terms of the markets and the economy? I just don't think they're going to be able to do enough while they're trying to cut to save off a recession. I mean, go back to the beginning of 2023. That there wasn't an analyst out there who wasn't predicting a recession that year. But then because of
we're all terribly wrong.
Yeah, everybody was wrong. It was the CHIPS Act and spending on the fiscal side. So, we just don't have that this time. And, I think the overall economy is kind of due for a contraction, because when's the last real recession that we had? I would argue that it is 2008, because 2020, that's not a recession. That was one of the black swan events.
Yeah, exactly.
One massive
2 months.
Yeah, you shut down the economy, of course things are going to be in a recession, but a true economic contraction, we've avoided that through measures that are not, that weren't true pure measures. We had quantitative easing, and then we had fiscal stimulus. So now that we don't have either of those, at some point the market the economies, it's got to just be able to last on its own. And I think that's what we're going to see. It's going to be a little tougher. And, my last point on this is that, I think whoever won the election has got a tough pill to swallow. I look at, what I've been telling clients is every elected official, their typical job is to get reelected. I mean, that's what their main focus usually is. And, for Trump, this is his second term, so he's not going to be able to get reelected, but the party is going to want to get reelected. And in 2028. So if you know that the economy needs to go through a recession, do you take it on the chin in the very beginning, knowing that America, we've got a pretty short memory because of social media and how fast the news cycle is these days, that Do you take it on the chin now so that everybody can forget when it's 2026, 2027, and we're in kind of a growth mode? That's the way I look at what they're doing right now. Is they're saying, let's get it out of the way, let's rip this Band-Aid off, and they are ripping it off fast. But they're doing it in a way that I think is I think people are going to wake up and go, wow, how did we get here so quick? But then they're going to forget about it when we're in that growth cycle around re-election time.
Yeah, I mean, it's kind of the ripping the Band-Aid off reminded me of 2022, which was the exact opposite. It was the typically it's a stairwell up, but that felt like a stairwell down, where you kind of, in hindsight, it probably would have been extremely painful and wouldn't have enjoyed it during that period of time. But had they just raised rates 5%, would it have been better off and recovered quickly? I don't know, but
it probably would have been better off to just let the economy just kind of go through its its issues and clean out some of the stuff that was a result of COVID. You think of all the companies that overspent, that overhired. Obviously, I know the tech sector, they did a lot of reduction in labor during that year, but I think we're gonna. Yeah, they still are. We're probably going to see more of that. And that kind of brings us to our next topic of, if we do go into a recession, one of the things that, we've obviously seen is that recessions typically increase unemployment. So if that happens, obviously that's life-changing for those who go through it. You've got, loss of income. But the side that not many people think about is the loss of the life insurance. A lot of people have life insurance that's tied to, their employer. So what would you tell someone who loses their job? Should they go out and get life insurance? What should they do about that employer coverage?
Yeah, I would look, depending on when you're having that conversation, ideally you have it like immediately following separation from employment so that you can potentially extend that, at least kind of like Cobra for a period of time until that individual gets on, ideally gets new employment, so new income, and then once that new income is in place and they're stable, let that roll off and get some sort of cheap term or whatever is appropriate for that individual in their own name that is no longer tied to their employment would be what at first glance how I would handle a situation like that. But I think a lot of that depends on the stage of life somebody's at, their savings, any number of factors. But having cheap term insurance at a young age is always encourageable in my opinion.
Absolutely. And that's one of the reasons why I bring this up, is because I think about it as having the same conversation when the market was at an all-time high. Right now, employment's at a great number, where we just ticked up from 4% to 4.1, which is well below the historical norm of 5.7%. So it's not like people are losing their job right now, but if you look at your life and go, okay, if something happened to my life insurance, I'd be a little worried because I do have a young family or something like that. Then that's something you should start addressing now, in terms of, let me figure out how I can, self-insure outside of that. A lot of people don't explore that because it's all built throughout their employer.
Yeah, it's like buying insurance once the house is on fire. You always buy it before the casualty.
That's true. Well, that kind of ties into our next topic here. So donor advised funds. This is something, Matt, that I know you've been working a lot on lately. So I want to let you kind of take that over and just tell everybody, what are donor advised funds? When do you use them, and how have you been leveraging these lately?
Yeah, so those of you that might not be familiar, donor advised funds are a great way for individuals to donate to charity in a very tax efficient way. So if you make a donation to, call it United Healthcare or your church, you can make that donation directly to them and get the deduction. Or you could what's called bundle or group your donation. Say you're selling a business or go through a divorce or have some sort of large liquidation event that creates, or maybe your just income is very high and you've got, you want a large deduction. Donor advised funds are a excellent tool to accomplish that. So say you give $10,000 to your church every year. Instead of giving it directly to the church, you could give it to a donor advised fund through Fidelity, Schwab, there's any number of them. And then you get the deduction for making the donation to Schwab Charitable that's in your name. And then you make the donation from the donor advised fund to your church as you see fit.
So now, why would you do that as opposed to just donating? Because this is a question I get all the time. Why would I do that instead of just donating directly to the charity?
Yeah, so it's especially beneficial in high income years or years where you have like a very large, like selling a business or where taxes are unusually high, where, okay, you're nearing retirement, you just sold your business, and say you've got $1 million capital gain. Instead of getting the deduction each year, you could make a one-time, call it $100,000 deduction to your donor advised fund, reduce your taxes that year, and then do it that way. So it's more, that's where the tax considerations come into play. And so that's really the main reason. And two, what a lot of people do is donate appreciated securities. So you were hitting on tech employees earlier. So say you've got a large position of employer stock. You could donate some of that to your donor advised fund, get the deduction, and then make the donation that way. So you're avoiding paying that capital gains tax on selling the security, raising the cash, and then making the donation. So that's another tax benefit to donor advised funds.
So it's probably a really good idea to consider that now because, yes, even though the market's down, it's not down, the 20-30% correction like we've seen in the past.
We're at September highs on like the NASDAQ.
So it's not like, this is pretty recent. We're not going back to 2020 lows or 2022 lows yet. So great time to consider that. So, and I know that was important to share because we've been having a lot of those conversations lately. But one of the conversations I've been having a lot with clients lately, especially on the retirement front, is just making sure that people don't outlive their assets. And this is obviously this is the number one fear that retirees have is running out of money. And so I wanted to give an opportunity for you. I would love to hear your take on what strategies are you helping clients with to make sure that they're not running out of money when they're retired?
Yeah. So if longevity is on your side, this can affect when you claim Social Security. That's one way to do it at the, call it base level. Then there's financial planning software that both of us use to ensure, okay, like if somebody's parents live to be 105 and they look to be in very good health, stretching out their financial plan to be 100 to see what it looks like, or any number that's appropriate there. So really aligning spending with your assets to make sure that, are you eating into your principal? If so, is it just a little bit, or are you spending 10% a year? In that case, that doesn't bode very well for meeting those needs over a very long period of time. And so I think this over the course of both of our careers over the next 20, 30, 40 years, I think this will become very important as health improvements and the average age, I believe, starts to really get out there past, call it 80 as being your average benchmark.
Yeah. Well, it's funny because I, one of the things I always tell clients is that it's so important to plan in retirement. A lot of people don't think of it like this. They think, well, let me do the plan. Let me get to retirement. And then once I'm retired, boom, I don't have to plan anymore. But the reality is that, and you know this, that you most people who retire, let's say you retired this year, you're not running out of money this year. You're not going to retire if you had any risk of running out of money this year or even in the next 5 years. Really the risk is, are you doing damage in this current year or next year for 10, 15, 20 years from now? And that's what planning, really helps, because yes, if you needed to reduce your spending, you probably want to know that as early as possible. And on the other side, let's say you could spend more. I've got a lot of clients that can spend more money than what they initially planned, but it's through that active planning where they get the confidence to actually go out and spend that money. So, it's just, I cannot stress how important it is.
Yeah, exactly. To the two common scenarios, like I've met with a lot of people that maybe have just enough to retire and they're trying to retire early, and you try to get them to keep working just a year or two more to give some more flexibility, so that you definitely don't want to get to somebody that gets in a bind that's 80 years old and is way past their working prime years, when they could have kept working another year or taken a part-time job or whatever it may be, even if they could have technically retired at 62. So that's one common scenario. And then to your point of getting people to spend more, this is something I would say see 3 out of 4 times. Is the more likely scenario is, okay, your financial plan shows you spending $200,000 a year. What's that? A little less than $20,000 a month, but your assets and all of that show, hey, you could easily be spending $300,000. And so, what do you want to spend it? Even just making people aware, even though it might be a couple years until they do some additional gifting or whatever it may be, or it gives them a lot of confidence during times of high volatility that, hey, we planned for this, we're totally fine, keep doing what we're doing.
Yeah, because that's a great point, because we are at the point where retirement has to last a lot longer than most people think, and that kind of ties into our last topic that I want to have a little fun with, which is retire fit. I think of the amount of people who retire and then they want to live this long life, and we want to plan until they're 90 to 100 years old. I always tell clients, I want them to be that story of that 110-year-old that, they say takes a walk around the block every day, drinks a Diet Coke, and, does the same thing every single day. But, to do that, you've got to have some sort of fitness. And I came across a great article that was talking about how we didn't evolve to exercise. Exercise is something that, this whole thought of fitness and going to the gym is not something that was natural, especially as cave people. But one of the things that we've done as a society is we've engineered movement out of our life. Everything we do has gotten easier for us. And so, thinking of ways where, I have these conversations with family members, and I've had them with some clients as well, ideas to just stay active, because your health is going to be the biggest cost, as well as, probably one of the things that can impact your long-term enjoyment of retirement. So any advice that you would have for someone who's thinking about getting active in retirement? Because I've got a whole list here.
More at a high level, it is interesting to just look at. I've got one grandparent that's still alive, and she's in her early mid 90s and smoked cigarettes for probably 60 or 70 years. But I would say she's on the genetic side, and but in hindsight, I do remember she had weights growing up, and I think she stayed more active than she let on. So that had something to do with some of that longevity. But then you look at my parents, and they're mid 60s or so. They're somewhat active, but they were still before that whole kind of workout generation that I think both of us fall into, where it became more popular or just normal. But I would say just getting out and moving, staying active.
Well, here's a list. I want to share this list with you. I want to get your thoughts on this.
Yeah.
I want to get your thoughts on this list of ideas to reintroduce natural movement, because as the article mentioned, it's been engineered out of what we do. And so the first one, which I just don't know if I could get behind, park further from the entrance.
Yeah, that's easy. I thought about that one.
We live in Texas, and the weather is too volatile for me, so I'm not going to do that one. Take the stairs instead of the elevator.
That's an easy one, especially the stairs up is much harder going up than down.
See, my dad is similar to your grandma, probably smoked for 34 years, and he's listened to this, and so he knows I'm going to talk about him. But this third one, it involves him. So it says walk or bike instead of driving short distances. So my dad just celebrated a birthday, and he wanted me to get him a bike for his birthday. The problem is he wanted an electric bike. So it's not doing him any good getting exercise. So my favorite on this list was get a dog and walk it. I think that's more work than just the exercise.
Yeah, I don't know about that. I'm on board with the first ones, but
so it's funny to hear the different ideas that are out there. But it is important. I think what people don't realize is that the correlation between health and the cost of health down the road. We're not saying just go out and be healthy and get your steps in and run a marathon and eat a bunch of broccoli, but it's all the little things right now. It's kind of like compounding effects in a portfolio. The earlier you start saving, the bigger your portfolio is going to be at 60 years old or 65 years old. Well, the earlier you start introducing movement to your lifestyle and exercise, the healthier you're going to be, the longer you're going to live, the less you're going to spend on healthcare. So it all kind of ties together. So
I agree with.
Let's jump into the wrap up here. What do you want to leave the listeners with? What's your one takeaway from this week? Because we got a whole new episode coming up next week that we got to dive into as well. But what do you want them to take away from this week?
This too shall pass. Keep it simple. Stay calm. This too shall pass. Don't, if at all possible, stop selling and start buying. What do you got?
I can't think of anything better than that. Just this too shall pass. So I love that. I don't even need to fill the rest of the 20-second timer for this. That is the best piece of advice, is just realizing that this is normal. This happens before. It's going to happen again. This isn't the first correction. This isn't the last correction. And you know what? As we all know, bull markets are a lot more fun than bear markets, but this is what we got to do to play the game. With that,
this too shall pass.
It will. And so we will see you guys all next week in our next episode. So thanks for listening, and we'll see you then.